if you look at the historical performance of the Nasdaq over the last decade is in the very, very high teens, almost 20%, which is high. And a lot of people out there would go, that seems excessively high, and it's never always been that way, which it hasn't. But then when you look at the composition of the Nasdaq, ignoring the video for the moment, but if you've got an iPhone, or if you don't have an iPhone and you're using Microsoft and you're drinking your Starbucks coffee whilst watching somebody charge their Tesla, that's all major componentry within the Nasdaq. And then you watched Netflix last night. These are all businesses that people are very, very heavily engaged with today. Hey guys, welcome to this week's Money and Investing Show. We're looking at 5 of the major factors affecting markets as we go into the second half of 2024. Some big things going on in the world right now, and laying the pieces of the puzzle out on the table is a great way for you to be prepared so that you don't find yourself in the crosshairs having to make rash decisions based on uncertainty, and instead can have a business plan that will let you yield great profits. Take plenty of notes, but as always, make sure you take plenty of action. Hey guys, welcome to this week's Money and Investing Show with me, your host, Andrew Baxter, and as always, my co-host and offsider, Mitchell Olarenshaw.
Good to be here, Mr. B. Now, the young fella that I am, certainly like to follow the trends, but not the kind of trends most 20-year-olds are following. Talking about stock market trends, and specifically today, I'm going to focus on 5 of the major trends of 2024 for stock markets.
Very good, yeah. I mean, it's we're over the halfway point for the year, and look, the interesting thing with trends and fashion, it comes and goes, but style lasts a lifetime.
Oof, I love that.
And I think we've been in what has been a significant bull run for markets, at least the US, for the last couple of years since 2022. Are we in for a change? What could be some of the catalysts for it? And I guess we can unpack and explore those as we go through this right now.
All right, well, let's kick off. And I think the number one trend of 2024, I mean, this is easy, has to be artificial intelligence and tech stocks. That's been the overperformer this year by a country mile.
Look, it has, and it's a second year overperformer too. I think the Nasdaq last year put on around 54% for the year, and this year to date had really come out of the blocks screaming hard, and then it didn't. And I think what we've talked about in multiple podcasts this year has been that really narrow market breadth, whereby the market in itself has been driven by a relatively small number of stocks, NVIDIA, of course, being the big one in that AI space. And then when there's a shift in tempo in the music, it bites pretty hard because those gains can be eroded fairly quickly. Over the top of that, of course, too, is, and I guess we'll talk about protectionism and tariffs as well as some of the geopolitics going on in the world too, but that has really focused in on that sector in particular, and until we see a little bit of a swing back in sentiment, I think could just be a little bit of a dark shadow sitting over the market.
It's funny you say that. I think with tariffs and also with potential overvaluations of a lot of those stocks, we've seen a huge transition of money out of tech in those speculative areas of the market into small cap stocks. So for example, last week, without wishing to date this podcast, the Russell 2000, which is the small cap index for our listeners in the US, had its greatest degree of outperformance relative to the S&P in a number of decades. I think it was 30 or 40 years.
Money's got to go somewhere, and you're right, there's been such significant hyperbole and hype sitting around the tech sector that it's, and look, let's face it, the tech sector has changed the world. It's where people live. Like we had this conversation this morning for the benefit of everyone here, management meeting, and we're talking about, if you look at the historical performance of the Nasdaq over the last decade is in the very, very high teens, almost 20%, which is high. And a lot of people out there would go, that seems excessively high, and it's never always been that way, which it hasn't. But then when you look at the composition of the Nasdaq, ignoring the video for the moment, but if you've got an iPhone, or if you don't have an iPhone and you're using Microsoft and you're drinking your Starbucks coffee whilst watching somebody charge their Tesla, that's all major componentry within the Nasdaq. And then you watched Netflix last night. These are all businesses that people are very, very heavily engaged with today, that form the guts, and you weren't sure where to go, so you looked at Google, and the list goes on. It's not surprising to see such massive outperformance there. And then within that subset, AI and in particular NVIDIA, but some of those big caps have been driven by this expectation that AI is going to be this huge game changer and the earnings are going to go through the roof and all these efficiency measures are going to be there. But if they don't materialize, those stocks will pull back because they've been stretched up on that. So maybe we've started to see the start of that too. Who knows?
Potentially, and we are in earnings season as well, so if they are going to prove themselves, then now is going to be the time. The challenge they've got is even with really good earnings, if it's not as just as amazing.
Uber good earnings.
Uber good earnings, it has to be to go up. They're priced for growth and they're priced for the expectations, which are ridiculous. So even though it might be strong, it might not be that strong, which is a real risk for those stocks right now.
Very much so. Buyer beware. So, it's one of those things you've got to be very careful with when it comes to your analysis. And like we teach a lot of different ways of getting into markets. Look at the trend, technical analysis right now. You'd be a brave man to be hopping in on the beer, the bang right now.
Indeed. Now, what about trend number 2AB, a controversial one at that? We'll try and keep this contained, and that is ESG investing. It's been a big part of 2024.
Yeah. How contained are we got to be with this?
Pretty contained.
So we've covered this a few times this year. We talked about black energy as one thing. We talked about ESG very specifically. I had my good buddy Shoes, James Harwood, on to talk about the performance of ESG portfolios too. And look, I think there's a real change in tempo in the economy and in markets right now. And some of the things that drive that come down to when you're in boom times, if you're, I'll be very candid with my wording here, a progressive thinker, the environment, which is important, we have one planet that's our home, and anything supporting that in terms of green gets your vote of approval. But when dollars are tight and you've got to put food on the table, the priority can shift. And I think we go back to, say, 2019, which I think, to use the term, was peak Thunberg hype around ESG, and particularly the environment. And we've seen lots and lots of companies come out with great inroads in that space, but we're starting to see some cracks emerge there. And not just companies, countries too. So for example, the UK last year has kind of turned its back on its carbon neutral 2050 plan because we simply can't afford it, which is understandable. The UK economy breaks my heart to see this great hub of the global empire where the sun never set, really struggling at the moment in terms of a lack of vision and leadership to get it where it should be. But they've turned their back on 2050 as a net zero target, saying it can't be done, it's not a priority, we're going to have to focus on other things like maybe making sure people have got healthcare and education and benefits and so on and so forth. If we look at that on a more granular level from a corporate perspective, companies like Fortescue Metals, and we did talk about this very specifically in a podcast, where the notion of green hydrogen was going to be a huge driver for Fortescue, and to an extent I think the company has done something of a backflip on there. The irony being, to produce hydrogen, there's an abundance of water on the planet, and to produce hydrogen is actually very, very energy intensive. So with higher energy costs as a consequence of shifts in energy supply, it's now become cost prohibitive to create green energy using hydrogen. It's just not effective at this point in time. So Fortescue winding back their aspirations in that space, which is, I think, a tremendous shame insofar as we said in the previous podcast, if anyone can pull it off, it's Twiggy, and that doesn't seem to be happening, which shows you just how strong those headwinds of a crusade to green energy can be when it comes to the practicalities of it. If we take a look at Tesla, for example, at the moment, and they've come out now with two pretty weak quarters of sales. And there are a number of reasons for that. Number one is a significantly higher level of competition in the EV space, particularly from China. And we'll get on and talk about tariffs, I'm sure, in a few moments, which is sort of cut their lunch a little bit from having the monopoly to not. And secondly is just a very, very expensive vehicle where has a pretty low second-hand value. And in days like now where people are maybe a little bit more budget conscious rather than being a little more progressive in their thinking perhaps, that notion of spending more on a car that's going to be worth much less down the line is a fairly difficult pill to swallow when you're struggling to pay your mortgage or other bills. And that's been reflected in weaker sales for that business too. So these are just some of the little blips, if you will, that come up on my news radar when it comes to that. And I think maybe, if we see a Republican win in the US election later this year, I think that might be the full swing of that sort of liberal ESG kind of mandate in the US, and we might see a bit of a swing back to a little bit more of a conservative train of thought.
Interesting. Okay. What about interest rates? Because that's a major economic factor, which has dictated the movement of markets and the sentiment around markets. Now, we are, without wishing to date this podcast again, likely about to head into a rate cutting cycle, particularly in September, is where the market prices it at.
Yep.
Why has that been so important for markets this year?
Look, everyone's been hanging their colours to the inflation flag, and we've been through an environment where we've had free money effectively, and then money became expensive, and that's quite evident if we look in Australia, for example, at the number of builders or developers that are falling over because you've bought a project, you're going to build, you're going to do all this, your construction costs have gone through the roof, and also the cost of finance has gone through the roof, and people's ability to borrow and pay top dollar for the finished product isn't there anymore in terms of serviceability. So interest rates are a really, really important factor on here. And I think, yes, in the US, we are about to see some cuts. I'm still on the fence. I think we still have a further rate rise to see here in Australia. And I know the RBA are probably very reluctant due to political pressure and public opinion to want to do that. But it's something that needs to happen in order to remove some of the excessive government spending out of the economy and get inflation under control. So we're at a bit of a two-tier situation there. And for markets, certainly US companies, as we start to see that fall in interest rates, the cost of borrowing comes down, you can invest more in your business, increasing productivity, increasing capacity, all of those sorts of things. And also, of course, it takes the foot off the throat of the consumer that's been struggling under debt repayment, for example, and mortgage payments too. So that's a potential boon for consumer activity and certainly corporate activity too.
Indeed. And it's funny when we talk about interest rates, and look, we've both been doing this for a number of years, you obviously a lot longer than I have, but particularly this year and last, just how built up those, say, for example, CPI announcements are, or the FOMC policy meetings. 3-4 years ago, it wasn't that big of a deal, and I feel like now that is the entire news flow. Yeah,
if you're the central banker or spokesperson for, you're the rock star at the moment because all eyes seem to be focused on you, and really, that return to, and I think it was a comment about politics. Politics should be, boring and bland and middle of the road and not that exciting. That's when everything is normal. When it's pizzazz and noise and everyone's having their seat to watch it, that's not how you want it. And I think when it comes to inflation, you just want it no pizzazz, boring. Right. There's nothing to see here. It's under control. But we're not at that stage at the moment. There's an enormous amount of focus on our central bankers and to make the right choice. And they get a lot of pressure. They also get very well remunerated with very little downside consequence to poor quality decision too. So the pressure is on them to make the right decisions, and let's hope they do. I think we will see another rate hike in Australia, and I'm pretty sure we're going to see a rate cut in the US. Good for the US economy, good for US companies. It's going to put further pressure on Australia, and I think particularly our property sector.
Yep. Well, let's hope not. Fingers crossed we don't see that. But we also see inflation contained. That's the caveat.
It's just the cost of living, Mitch. I mean, it is nuts. Like, anecdotally, we were up here, we brought the kids up at the weekend, we're at the AFL on Saturday, and Sunday morning went across to the farmers markets, which is what we used to do when we were living on the Gold Coast. And just getting breakfast, it was just like, holy smokes, it's so... I
was at the farmers markets too, actually, on Sunday.
There you go.
At Hodder.
At Hodder, indeed.
Surprised I didn't bump into you.
Yeah, well, lucky you didn't, because I had all 5 kids with me, so it was a fair mob. But just the cost of like a couple of coffees and then some juice and some food, and it's like, holy smokes, it's $180, $190 before you start. And okay, I'm not on a budget like in the traditional sense, but you just wonder how everyday people are really getting by on that, and it's brutal. So we've got to get that cost of living under control for people. It's a killer. It's an area that everyone wants to try and ignore, even though they talk about it. So if it's a rate rise that's needed to have the medicine now to get the cure down the line, that's what we've got to do.
Indeed. Now, moving forward, our penultimate topic of today would be geopolitics, because we've seen, as you say, almost a circus this year of different stuff going on, politically speaking. Any thoughts?
Yeah, it's a kaleidoscope, really. Where do you want to start with this? Let's start with...
We've got to be careful here.
Wars. We've got 2 wars going on at the moment, neither of which appear to have an end in sight. The one in the Middle East appears to be escalating a little at the moment, and part of that is because of the political vacuum that's been created in that space too. But the potential for a third engagement in the South China Sea with Taiwan is also a very real proposition, and I think as markets are concerned, they've become somewhat immune to noise around wars. Like, we think about the war when it kicked off in the Ukraine with Russia's invasion of the Ukraine. Food prices went through the roof on the very short term, given the Ukraine is a major grain producer. And we saw oil prices jump up, and then it kind of eased back out of the market. We had a very short-term spike in volatility in energy prices on the Israel-Gaza conflict when that kicked off, and then it's kind of fallen away. And it's almost as if markets are kind of wearing headphones, noise-cancelling headphones towards conflict, and that's okay. There's nothing to see here, which is extraordinary. You can see that priced in volatility, which up until 10 days ago was relatively low by historical standards, given what's going on. So, there's always scope for something else to happen in that arena, in the war arena, and Taiwan would be a major one. That would be of a gargantuan situation. And given the political state in the US at the moment, where you've got an incumbent president who, and I'm inclined to go along with this statement, is probably a president in name only, and probably has been for a few years, I think it would be fair to say. That does create a power vacuum for stronger countries that have aspirations on the global stage to step into that gap of weakness, to get what they want while they can. And that's not good for markets, or potentially not good for markets at least.
Indeed.
Elsewhere, what else have we got?
Emerging markets.
Elections. Let's
before we go on. Sorry, yes.
Let's get into elections. I mean, we've got the big one coming up. We've seen, and this year will go down in history, I think, as more of the world has been under election than any other time in history. So we've had just some of the big countries: South Africa, India, Mexico, the UK, France, of course the US, Russia, have all been to the elections this year, or are coming to the elections. The big one, of course, being in the US. And I mean, that game has changed a little bit from 10 days ago, where you had a Trump-Biden, and now it's a Trump-Harris, and it'll be very, very interesting to see how that plays out. It's just so tribal. It's sad to really see on the sidelines where politics has actually gone from. I sat back and, as you know, I love news and I love current affairs, and I watched a couple of the presidential debates from the Bush era, which is only 15, 16 years ago, or even the Reagan era, which was through the sort of late 80s. And there was a level of respect for people, whereby here's some policies, this is my view, that's your view, I'm going to debate you on your opinion and show you why it's wrong, and I'm going to do so in a way that's fact-based rather than just an outright personal attack. And it's really sad that that's where we've got to, but I guess we've got junk TV and social media to thank for that sort of culmination in the way that we seem to govern ourselves now, which is really sad. Part of the thing that's come out of that is tariffs. Politically motivated, I think, on the part of the Biden administration currently, where there's been a hike in EV tariffs to try and protect the American car EV manufacturers, principally Tesla, which has come very late in the day. It's only something that's just happened, as opposed to 3 years ago at the start of an administration. So I think it's a bit of political posturing. And of course, we know President Trump is a fan of tariffs, as we saw from his first term as the 45th president, where tariffs were used to level the playing field, so to speak, at least from his perspective, for American businesses. And he's made it quite clear that that's something that he's most open to re-engaging again. And I think that notion of the US becoming more protectionist and isolationist and removing itself from the global stage, it's a double-edged sword. It's probably good for the US economy, but it does, when you pull back and focus internally, does create a vacuum externally. And I think the mandate from the US is that, well, we're expecting the rest of the world to be able to govern itself. Why should we have to be the world's policeman and pay for it? Which, comments from Trump about, for example, Taiwan having to pay for its own defence, rather like what he said to Germany and NATO during his previous presidency, is actually quite a good question to ask, but does create ructions for sure. So it'll be very, very interesting to see how that pans out. Indeed.
Last but not least, let's talk about emerging markets nice and quickly, AB. I know this has been an area of your portfolio that you've capitalised on very effectively. For the overall stock market, though, what's been the trend this year?
Yeah, emerging markets generally have done quite well. There's been less inflation, for example, in the Asian countries, so you've had less of an impact of interest rates. India is one we've talked about a lot in terms of that demographic shift and the economic shifts within India, where it's becoming the underclass of very, very poor people on less than $5 a day are now earning $10 a day. It's going to be the world's largest phone market within the next 2 years. People will have access to the internet banking and everything that goes alongside that. And that is tracking along very, very nicely, and I'd expect it would. There was some political uncertainty there. Modi's government did get re-elected, albeit with a much smaller majority, so there was some good volatility through there, but nerve-wracking for a few days before the music came back on and continue to move forward. Other emerging markets include things like Mexico, which we've talked about too, where being part of NAFTA, the North American Free Trade Agreement, the US, Canada, and Mexico being the participants of that, the trade across the border is relatively easy, and I can continue to imagine that zoning for manufacturing is in the US time zone. You don't have to put stuff on a boat to ship it. You can put it on a truck and drive it across the border. As I say, the convenience of being in your own time zone with no tariffs and so on make for a very, very strong case for that. And if we do see the Trump administration elected as the 47th president, those tariffs that come through, I think, will probably be quite supportive for Mexico. Ironically, even though a lot of the campaign is about border protection, that's in terms of migration and particularly illegal immigration versus actual trade.
Interesting, maybe. Well, look, really good insight. There's top 5 major trends for this year in 2024. I guess the question is, where do we head from here?
There's a lot going on there, and I think we're at a point in time finally where the question mark of uncertainty is kind of caught up with markets. We've been sort of scratching our head for the last 8 months as to why volatility is so low, given all this stuff is going on, whether it be a known event or an unknown as far as a war is concerned. And I think it's starting to come to the fore now that actually, no, heck, there is a lot of uncertainty out there, and markets are a lot more jittery now than they probably were a month or so ago. And I suspect as we inch closer towards that November 6th election, there's a very high probability that we're going to continue to see some uncertainty out there as people are trying to work out where to position themselves at the end of the day. And look, I think ultimately we'll see the market move higher from here. Because typically it does move up over time, but it may not be quite as smooth sailing as perhaps we've become accustomed to over the last 18 months, 2 years. But that's okay. It creates opportunities within itself, particularly that sort of sector rotation as tariffs bite certain places but not others. So stick close to the lava flow, watch what we do, keep your eye on our recommendations, and I'm sure we'll keep you safe and moving forward.
Couldn't have said it any better, AB. Thank you very much.
My pleasure, anytime. There you have it, guys. Make sure you like, comment, subscribe. Most importantly, hit the notification button, and we'll look forward to hosting you next week.